Thank you, Reese. So, good morning, good afternoon, good evening, everyone. Um, Welcome to this. This is the one time I'm going to use the word conference. It's really a workshop or a discussion on fintech and the future of payments. I'm tempted to introduce it with an anecdote. An economist and a political scientist walk into a bar. But the reality was an economist and a political scientist walked into a delicatessen for lunch, and conversation in the first instance about Libra and blockchain. And over this series of lunches, we pretty quickly realized that it wasn't about Libra or blockchain or distributed ledger technology. Rather, it was about a cluster of developments in the payments and fintech space. And it was about competition amongst digital platforms that involved payments and other information-related digital functions that we had to understand and get our minds around. So that is the nature of the conversation we're hoping to have for the next couple of days about that cluster of changes affecting payments in fintech, and about competition between the platforms with names like Ant Financial, Visa and MasterCard, Facebook, whatever, and how that will affect the evolution of this space and the relevant technologies. Discussion has to start with some context, and what better context than history. So the first session will feature a presentation by Steve Quinn and Will Robards, and commentary by Brad DeLong on the history of payments with an eye toward the future. So Steve, I think you're going to kick it off.
Right. Good morning. I'd like to thank Professor Eichengreen and everyone at Cal Berkeley for organizing this and the invitation. My colleague Will Roberts and I are going to take our time to focus in particular on the relationship between payment systems and the state over a fairly long period. And we'd like to draw our attention to a few interactions between the state and payment systems. One is going to be the role of the state in providing a money that acts as an anchor. Another will be on the state supplying regulations. And then also thinking about how all this develops over time, which is something history can bring to the table. So an evolutionary perspective on innovation, crises, regulations, and all of that working together. I'd actually like to start with an analytical framework that we find helpful for applying things, comparing things over time. On the vertical dimension, we're going to go with risk, which is the risk that the payments technology doesn't work. My son recently loaded Apple Pay onto his phone, went to the pizzeria, only to discover the pizzeria did not take Apple Pay, and he discovered the risk a payment technology did not work. On the horizontal, we're going to go with cost, sort of the all-in economic opportunity cost of using a technology. You can also think of it as inconvenience as you move to the right. And when you put these two dimensions out there, it lets you start thinking in terms of trade-offs, that most of your technologies in the payment space are going to involve trade-offs. Again, one thing you have to give up another. And when you do this, for example, you'll usually find that in the lower right corner, you'll find a successful state money acting as an anchor to the system, because it's very difficult to get less risk than a successful state money. When we say successful, by the way, we mean state money that people want to use. This is beyond being compelled to use. Indeed, people want to use it, usually people outside of the creating jurisdiction. Then building up from that, you often will see then development of private innovations that are cost saving or convenience increasing at usually the expense of increasing risk. We'll use these two dimensions, but this approach you can expand to think in terms of retail versus wholesale, privacy versus know your customers. There's lots of ways of playing with it. So a first example I'd like to consider is Venice around 1500 or so. The state supplied successful anchor is the Venetian ducat, a coin that was the international standard at that time. But of course, it's a coin, it's expensive, it's hard to use. And so you get the development of paper-based credit technologies to try to avoid the use of coins. One would be the bill of exchange. It was used for longer distance payments, and it reduces costs of shipping coin, but it introduces counterparty risk of the debtor not paying you back. Then also in Venice, you'll see the rise of deposit banks for local payments, which reduce costs or increases convenience even more, but not only has a counterparty risk, but also introduces the risk of the bank itself failing, whereas banks have been and continue to be vulnerable to that. So what we like about this approach is it gets on the table right away that you have a variety or a heterogeneity of payment approaches. And the reason is because there are trade-offs. And the more trade-offs you add, the more you can start appreciating why there's a variety of stuff. But the state anchor really tends to be what's building the structure, or the structure is built on it. And so this framework lets us think about advancement or economic development in these technologies. And so an older system of dealing with avoiding coin is just old-fashioned merchant credit. And so you can think of deposit banks and bills of exchange as ways of getting around that, ways that either reduce costs for the same risk or reduce risk for the same costs, or some combination of the two. And so you can think about private sector development as moving towards the origin and creating real economic gains for the users. Appreciate also as a background that these kinds of gains usually require the state to also supply rule of law, stable property rights, that sort of thing. And also these technologies like deposit banks and bills of exchange are network technologies. They take time to develop, but on the other hand can fall apart very quickly. So one way we might think about fintech is it bringing this sort of advance to the payments space? Next way we want to play with this scheme is to think about the anchor itself. And this brings things to the research of Will Roberts and myself in Amsterdam as an example of, in this case, a paper anchor. In this era, the early modern era, 1600s, 1700s, you see the development of these public bank ledgers and the like. They're working in a difficult environment because there's a shortage of coins, and coins are also very high value collateral. And so it's a very expensive thing to hold on to. And at the same time, nation states are developing ever greater levels of sovereign debt, and they're working with different ways of getting public banks to navigate these problems for them. These problems are very real. These state-created entities rarely have some kind of asset that the public sector, private sector rivals don't also have. And so what they're really trying to do is come up with a more trustworthy combination of things than other options. And this is actually very difficult. Sometimes it happens, and it happens almost in a magical combination. Famous example being the Bank of England. We're hoping people will become more aware of the Bank of Amsterdam as another example. But I want to stress at this point, there's a great deal of survivor bias here. Lots of efforts were made, many did not succeed, and many people don't even know anything about. Some awarenesses of France and John Law's system in 1720, which failed spectacularly, but most died a quiet death and few people think about them. But the problems are very real. And so we'll talk about a success, but most are not, in fact, a success because the political economy is really tricky. The long run success of these entities involves always some form of political risk. And there's a lot of moving parts there. Two we would highlight and are often in tension is credibility and legitimacy. Credibility is the expectation that you'll pay back your money if you have a redemption option, or if you're a fiat currency, that you'll maintain the value of your money. Legitimacy is the perceived appropriateness of you as an application of state power. And without legitimacy, political risk goes up very quickly. And the tension, of course, is that to gain political legitimacy, one often needs to be very close to the sources of power, but that, of course, undermines or can undermine credibility. And so the balancing of this is a very, very tricky business. Paul Tucker these days has been talking a lot about narrow mandates for central bank. That was a way of doing it. The Bank of Amsterdam managed this trick by being a municipal or city entity. And so it was not directly answering to the provincial or federal levels. And it was those levels that produced most of the sovereign debt. And because of that, the bank itself wasn't terribly deep into the sovereign debt world until the city needed it to be, which eventually happens, which eventually undermines the bank itself. But it was able to go many decades without having to go there. So if you pull off this alchemy, you can get what we would describe as a shift in the anchor. In this case, going from coins to ledger paper money. And the Bank of Amsterdam did do this, and it was very successful, not just in Amsterdam, but around Europe. The Bank of Amsterdam's ledger money became by sort of the dominant international currency of its age. So that's a very powerful thing in and of itself, but these kind of shifts also tend to create new space for dramatic innovation on the private side. And in the Amsterdam story, for example, you get the rise of merchant banking. And these merchant banks didn't take deposits. Instead, they used the Bank of Amsterdam ledger money as its base for using market funding, we would call today. They would borrow using bills on their liability side. They would lend using bills on their asset side. They had a form of a matched book structure, very similar to Wall Street today. And all that was built on Bank of Amsterdam ledger money. And this merchant banking not only was very successful in Amsterdam, but became the hub of credit for Northern Europe, and a great deal of international trade the goods did not go through Amsterdam, but the credit did. And so it was a very powerful thing. And it's conceivable Fintech could cause something like that to happen. The third bit I'd like to touch on is the relationship between state and payments in terms of regulation. And here we'd like to get a little closer in time and think about New York. So we all know the Great Depression led to a great deal of regulations. And you could simplify things by saying that those regulations like FDIC, Regulation Q, Glass-Steagall, were lowering the risk profile by forcing banks down that frontier. But then you get to the 1970s and inflation is accelerating, and it's very difficult, very unprofitable for banks, especially under Regulation Q, which limited rates on savings accounts, and I think it was zero on demand accounts. And so you get a lot of pressure to circumvent or get around regulations. And I want to stress quickly what we mean by banks isn't just what regulators say banks are, but a sort of a functional understanding. Or if banks are on the asset side, information sensitive lending or relationship lending, and on the liability side, they're supplying money like safe asset, obviously demand accounts, but other things too. That something is doing that is a bank. So we can think of that as a shadow bank. We'd also like to stress that that combination is very powerful. It's been happening for a long time. It will continue to want to happen because it is a very profitable arrangement. Those two sides draw themselves together. So whether it's regulated or recognized as regulated or not, it still will want to happen. And so in the New York example, we have this coming about. We have the rise of Wall Street investment banks that are using repo funding. So regulators would say, you're a bank, and Wall Street would say, no, we're not. Sure, we're doing lots of lending, but we're not offering demand accounts. But turns out if your repo is close enough to a demand account it can be run on, you're a shadow bank. Other examples could be money market mutual funds or asset-backed commercial paper conduits, which are going to say we're not banks because our asset sides are very safe, until it's discovered later on that they're not. And so what these innovations are doing is, you can also think of them as circumventing the regulatory structure to get back up and out that threshold. And so you can think of this as a dynamic over time. When you impose regulations, you start to get this kind of response. Indeed, I'd like to walk through thinking of this response in a much longer time frame. So if you go back to the National Banking Act of 1863, for example, in the middle of the Civil War, you get the introduction of national banks, of course. You get reserve requirements, capital requirements, limits on assets that a national bank could hold. So you get that up and running, and you find state banks and trusts get around those regulations. They move to offering checking accounts instead. And in time, you get these institutions being a major part of the system. And then you get a panic in 1907. Not only are trusts in New York not regulated as banks, they have a different and lighter regulatory structure. They're also outside of the lender of last resort structure that New York had at that time, which would be the New York clearinghouse. And so you have a major national crisis. And afterwards, there's political will, political energy to do something in response. And that builds through the National Monetary Commission and the like into the Federal Reserve Act of 1913, which, of course, introduces the Federal Reserve. It lays that on top of the national banking, adds some more regulations and the like. But the act does not require state banks or trusts, for that matter, to join the Fed, and few state banks do. So you get another period where you've got, if not shadow banks, shadowy banks that are avoiding the regulatory structure and, of course, are going to be outside of the lender of last resort structure, at least as the Fed understands it. And you eventually get another crisis, a very severe one this time, of course, the Great Contraction, 1929 through 1933, where state banks are a great deal of the banks that go under. But by the end, of course, the pain is very widespread and ends with the famous National Bank holiday, where the entire payment system is shut down. Indeed, the Fed suffers a run on it directly. So you get done with that, and there's another move, political energy to do something about all this, and you get the the Banking Act of 1933. This introduces FDIC, Regulation Q, Glass-Steagall. The era is also going to see regulation ending the domestic gold standard. You're going to see reformation of the Federal Reserve, concentrating it into a more centralized structure. And then that's fairly stable for some time until we get to the era we just mentioned. You get into the 70s and the pressure is building on the banking system. You're getting innovations, shadow banks circumventing the system. You get another dynamic, which we didn't add into this, which is you get pressure from the regulated entities trying to get a relaxation of regulations because the new entities are taking their lunch money. And this has happened in other eras also. And so this builds and builds until, of course, we get to the Panic of 2008, which everyone's already very familiar with, where the shadow bank entities are, again, outside of the lender of last resort structure going into it, and are going to be the center of the crisis. the crisis ends, and there's yet again a political will to do something about all of this, leading to the Dodd-Frank Act of 2010, which in turn is going to lead us to the kind of question we have now. When we think about fintech today, is it perhaps going to be a version of all of this, which is perhaps not really doing anything new, but providing a new way to circumvent old regulations? And that's one way to think about how these things evolve over time. So to start the process of pulling back out, we want to stress again that the payment system builds on usually private sector innovation. It's usually incremental. It takes a long time to build these networks. It's for-profit enterprises, but they're built on state anchors. Usually not only the money, but also rule of law, secure property rights, and a larger regime that is stable. Occasionally, you will have a successful introduction of a new anchor. The Amsterdam example was a paper anchor. These days you have, of course, electronic anchors. And not only is this a tricky thing to pull off in terms of political economy, it's a very powerful thing when it does work. You're going to get not only a great deal of attention on that new anchor, you're going to see a great deal of punctuated development, rapid innovation, building off of it. Whole new spaces can develop in terms of economic development. And then our third point is that all of this, because the banking-ish aspect of this stuff is so perennial, you keep getting regulations that attempt to reduce the risks now. But usually over time, pressure builds to get around those risks, either by circumventing the regulations or indeed sometimes by having political pressure to pull back on that regulation. And then you can get into an evolutionary cycle where another crisis develops and we get into a long-term cycle of really the dance of avoiding or circumventing regulations instead of perhaps expanding things into an economically beneficial space. And with that, I thank you for your time.
That was great, Steve. Thank you. Professor DeLong, you need to unmute yourself. You have 10 minutes.
Unmute myself?
You are unmuted.
I hopefully have managed to unmute myself. Let me just riff on what we've just heard. And let me start by saying that, as always with the good work of economic history, we see that the focus of the presentation is that history creates problems and opportunities for economic actors who then have to take steps to solve them. And the interesting thing is how they do so and what the consequences are, especially what are the unintended consequences. Since, the master move of economics is always that, the market combines individual actions to produce something that nobody expected. What we've heard so far has been a chartalist plus approach. And I think that's broadly correct, that the state is at the foundation of this as the anchor around which private entrepreneurs seek to gain wealth and advantage, given that the state with its own payments flows and taxing flows serves as an anchor on which others can build. But the state is much more than an anchor, is much more than a very large organization that keeps itself functioning, that collects a huge amount of wealth and then distributes a huge amount of wealth. And so if you can, kind of move in the slipstream of the state's operations, you can gain an awful lot of thick market and trust benefits. The state's also a first mover or maybe a last mover. The thing that when it innovates and adopts others' innovations, it then solidifies what the market and expectational equilibrium will be. And it's also a regulator in lots of sense. You know, it has people in the old days, people with spears, now people with guns, who ultimately can say what you can and cannot do, and ultimately say this is your wealth and this is not. And in that role, it is a forecloser of potential options that private sector entities might want to undertake, and also is often an appropriator of things that private sector entities wish to do, of sources of their advantage. You know, the South Sea Company's business model was, you know, a wonderful one. You know, we are going to take all of the many untradeable issues of British national debt created since the Glorious Revolution by the fact that in exchange for parliamentary dominance and political liberty, the English Parliament was willing to underwrite William III's wars to maintain the independence of Holland. Take all of these kind of illiquid assets, consolidate them, then sell them and trade them in a thick market, and so reap all of the thick market edge and all of the marketability edge, and divide it among the founding shareholders on a when issued basis. It was a wonderful business model, but ultimately the thing that successfully executed that business model was the Bank of England, not the South Sea Company. And when Isaac Newton said that he can calculate the motions of heavenly bodies, but not the madness of crowds, some supposedly, he ought to have been able to calculate the fact that a very large state actor that has better position to execute a private sector business plan that is now public will in the end be the thing to execute it. So we have successful state money, and on top of that, we have private entrepreneurs trying to do things that are cheaper and that reap the benefits of successful state money, which means that the payments flows and the assets and liabilities they create have got to be safe enough. And of course, in placid times they are, and always they are until they aren't. And when they stop being so, things get very fraught. Maybe the thing I should do is step back and say that a huge amount of economics is, and this is an idea I stole from Partha Dasgupta, is that you always seek to widen your circle of trust so you can deepen your division of labor. You know, and that you kind of start out in a world in which there are lots of commodities that you need and in which your own ability to produce things is limited. You start out with gift exchange or commodity exchange, and it's only with those who trust. And so you start out with your division of labor limited to your friends, your neighbors, and your kin. And I would not trust some of my neighbors, and I definitely would not trust many of my kin to engage in long-run win-win cycles of commodity exchange. And you then move on from there, and there's also something state-like, around. The Temple of Inanna, or the treasury of the great king, that you're confident you can deal with, and that in fact you have to deal with because it's collecting tithes or taxes. And then you have the invention of money, these little things made of precious metal that the king of Lydia warrants as being good in the case that he will take them, accept them in payment for taxes, and he will crucify anyone who counterfeits them, especially in adulterated form. And all of a sudden, your circle of commodity exchange has widened from your friends, kins, and neighbors, or from those plus the state, to everyone who can show you the money. And this is a great and wonderful thing. And this is a magnificent thing. But then the cycle repeats at a higher level, because as we just heard, with money, you have a 3%, say, kind of potential slippage simply from clipping coins. And you also have all the problems of counterfeiting and adulteration and so forth. Plus carrying large amounts, chests of money around is kind of difficult. The stuff is heavy, it needs to be guarded. It's both heavy and it's also fairly easy to conceal. Concealment causes problems. And heaviness causes problems. I do know that when I watched the movie The Italian Job, I kind of winced when they dropped the chest of gold down 4 stories into the motorboat that then sped away with it. Because I know enough about physics to know that that chest would have smashed the bottom of any boat, whatever underneath it of that size, and promptly gone to the bottom of the Venetian lagoon. And so moving from coins of gold or silver with the picture of the king on them to something better that you can still trust, is always the dance. From coin to bullion, where you at least supposed to be in standardized forms and you can weigh each one, to bullion being kept somewhere in someone's basement, to bullion as the backing for ledgers, to the transactions of a large organization that has money coming in and going out as backing for ledgers. This is the dance that we always do over time. And, we see it going from payments, from money to merchant credit to bills of exchange to deposit banks to large state-like anchors that seem to work, provided they have sufficient insulation. Apparently, recently, I've been talking too much about global warming and about geoengineering solutions to it. So it was insulation is what the computer wanted to type. Sufficient insulation from the fiscal needs of the state to prioritize the health of the financial system over the fact the state can use this to get a little bit more seigniorage. And of course, the state always pushes this margin, tries to figure out how to use its regulations to get more seigniorage. And in the long run, those organizations that succeed and many organizations that don't succeed are those that are somehow sufficiently insulated from the fiscal needs of the state to prioritize the financial system, but also somehow state-like enough to be concerned with the public interest, rather than at some point deciding that what they really want to do is take the money and run. I understand that at meetings of Federal Reserve boards of directors, sometimes people say, why do we set our dividend so low all the time? Why don't we just set the dividend very high and take essentially the positive balance in our vaults out to distribute it to ourselves, and everybody laughs. No. So, regulatory arbitrage by private entities, they're safe enough until they are not. And the state as seizer of opportunities. That if someone shows up and is large enough to actually begin taking on a state-like role, the state is going to get very nervous, or the central bank is going to get very nervous about who is the boss here and how will a crisis be handled here. And should this seigniorage-like wealth be going to someone who isn't us? So when you think of the state as regulator and as anchor, and as first mover and also as validator, we also need to be thinking of the state as forecloser of some public options or some private options, and maybe the forecloser of some private options because they are too risky, and maybe because they are too profitable for others, and maybe because they upset the current balance of forces within the state or within the state-like entity that is the central bank. And also as the appropriator of whatever that in the long run, the state as the largest player is going to be the one that can grab much of the thick market benefits of being the hub, as long as whatever its payment system it's running is trusted to be sufficiently insulated from the immediate fiscal needs of the rest of the government, which makes the problem of trying to be too great a financial innovator and get too wealthy, a very dicey and dangerous one. And of course, we talked about trust in commodities at the start. I talked about trust in payments. And there's also trust and long-term financing, which is a topic that is potentially very fraught going forward now in this era of, quote, secular stagnation, in which all of a sudden it seems that is not so much saving as rather risk-bearing capacity and entrepreneurial vision that are the places then which the economy feels constrained, rather than in the simple flow of liquidity or in the simple flow of savings. And
Brad, I see 10 more slides.
Stop there. No, let me stop there by saying, as Barry did at the start, Ant, Visa, Facebook Pay, question mark.
Okay, thank you.